If you buy a gold ETF, you might never actually own a single gram of gold. But if you buy physical gold, you could lose 10% of your investment the day you buy it. So why is gold popular as an investment? It's been a historical store of value for thousands of years. It's seen as a hedge against inflation, currency devaluation, market crashes. Central banks around the world hold gold as part of their reserves. But how you buy gold changes everything regarding the returns, the risks, and the costs. So you mainly have two ways of investing in gold, either physical gold or paper gold. Paper gold could be like ETFs, stocks, futures, or even companies that own gold or mine gold. So physical gold is like gold bars, coins, jewelry, and these are usually 24 karat 99.9% pure gold. You can usually buy them from gold dealers or mints. So the costs of owning physical gold are the premium of buying the item like jewelry or the bullion or whatever. There's some premium for like the minting or for the creating of the jewelry, crafting the jewelry. And then you have to pay for storage. Either you get like a safe or you get like a insured vault or like a safety deposit box in a bank, which you have to pay for these things. And another cost is the selling spreads. So when you buy and sell to a dealer, for example, they need to make their profit somewhere, so it might eat into your profit. The advantages are it's tangible, it's physical gold, it's like a piece of value that you have right here in your hand. It can be used in like an extreme financial crisis, like if banks shut down and everything and the world economy is like collapsing, but you have physical pieces of gold with you in your house or something. You can like go and trade that for something or do something with it. It's also fairly untraceable to some extent because it's just a piece of gold. It doesn't have any, generally speaking, doesn't have any like paper trail or something. So if you want, you could buy gold in one country and then go and sell it in another country and get that currency, and like no one will really know for sure that you've done this. So it has that privacy aspect. It doesn't necessarily have to mean you're doing something wrong. It's just privacy. And then some of the downsides of physical gold is of course, as we mentioned, the storage and insurance costs. And like if you keep it in your house or whatever, you could lose it. It could get stolen, something like that. It's not easy to just steal stocks or something from a portfolio, but someone could just come into your house and take pieces of gold. And it's less liquid than paper gold or paper assets. And there can sometimes be big spreads between the buying and selling prices. So what about paper gold? So paper gold can be like ETFs, futures, gold investment companies, mining companies, gold companies that are just holding gold. Maybe it could be banks or even just some company that happens to have gold on their balance sheet or whatever. So for gold ETFs, you basically invest an amount of money that buys you a share that represents an amount of gold held by that company or fund or whatever. So this, of course, you don't need to personally pay for storage or insurance or risk it getting stolen. It's liquid, easy. All the paper gold is pretty liquid and everything, so easy to buy and sell. But I mean, obviously the company that is holding the gold has probably got some kind of insurance or storage costs or something like that, so I'm sure they must be offsetting these costs onto you or onto someone. But you won't personally have to deal with them, and because they would be having huge quantities of gold, I think the cost per like gram of storage or whatever is not going to be that much. Whereas if you just have like one small brick of gold, you're going to have to pay just for this one piece, while they might have like a huge warehouse and adding a brick of gold wouldn't make a difference. The disadvantages of a gold ETF is that you don't technically own gold itself. You own like a share of a company that owns gold or something like that. You have like a claim to this gold. You do have to sort of trust the company that you're investing in, that they're not gonna like go bust or scam. Although I don't think this is much of an issue these days, because there is a lot of like regulations, and like a stock that would be available on an investment app, like if you are investing in a major gold fund by like a big company like iShares Gold Trust or something, which is like by BlackRock. These things are like unlikely to scam you or something like that. Remember, nothing in this video is financial advice, it's for entertainment purposes only, but basically, yeah, don't invest, like you wouldn't want to invest in like some random unknown shady company or something. But if it's like something by BlackRock, something huge, something that has got like billions under management and stuff, it's usually gonna not be an issue. But this is still just like a thing to consider, that it's not you yourself who has this gold in your pocket and you know exactly what's happening with it. And then you have gold futures, which is the high risk leveraged day trading sort of thing, which the average investor should probably avoid. You're not owning gold here either. You're not even owning a share of something that owns gold. You're just trading contracts basically. And these aren't for long-term holding. A lot of people like to keep gold for years and just keep them and pass them down in their family. So this is not like that at all. Like this, you probably don't even want to hold it for more than a day. So anyway, this is not a way to invest in gold realistically. You could like trade the price differences in the very short term, but gold isn't even volatile to that extent that you would get something that significant in one. You can, sometimes you can, but you would have to really know what you're doing. I personally haven't done very well with it. I did okay with silver, which was like over a couple of weeks and stuff, but even silver in one day, it was pretty tough. And I don't do futures anymore anyway, because you have to pay like interest to hold overnight and stuff like that. And then you have the gold mining stocks or companies that own gold. These are more volatile than owning physical gold or gold ETF or gold futures, because you're depending on the price of the gold and the management of the company and everything else about the company and their personal debts and whatever. So it's like unnecessary risk. I tried investing in a gold mining company and it just didn't do very well. So some people think that investing in an ETF that has gold is like fully backed, but the reality is that they usually use like unallocated gold. So you don't have like pile of gold with your name on it or something. It's like they give you like a promise that this is your gold because you've bought this many shares, and if you wanted to sell your shares, they'll be sold, sort of. You're not really selling the gold, you're just selling the shares. So the gold part is not, you don't really interact with the gold as such. But I mean, I don't think it's really an issue, because either way you can just benefit from the price differences of gold, the price changes of gold, without having to deal with the physical aspect and storage and whatever. So why not? And some people think that physical gold can never go down in value, or it just will always go up forever. But no, it's not true. Like, it can go down in value as well. Especially when it has come up so much, it can go down in value. Generally, like historically speaking, it does tend to go up, but it also depends on your investment plan and investment period. So there are some people who will buy it when it's high, and then after a couple of years they need to sell it, or that was their plan to sell it, and in that time it's gone down for some reason. And yes, it probably would continue going up in the next 5-10 years, but maybe in those few months or 1 year or 2 years that they bought it, it's gone down. So you do need to be prepared for it to go down. If you're planning to hold it for like 20 years or something, it's most likely not going to be an issue. But it's not something that you would just blindly buy and you know that next month it's going to be up. Another misconception is that jewelry is not necessarily an investment, because you're paying an extra premium for the crafting of this material, and especially if it's designer jewelry, if you're buying like Cartier and Van Cleef and stuff like that. These are even more, they have a lot of markup on the actual amount of gold. So the gold in grams might be worth like $500, but you're gonna pay like $2,000 for the piece, for example, because of the brand name and the styling, and sometimes they put diamonds and things like that, which don't add much investment value. So if you did want jewelry, gold jewelry to invest in, you're probably best off buying it from like those jewelry shops which are like unbranded and they sell it almost at the gram price. So that way you'll have jewelry that you can enjoy and wear. And if gold's value goes up when you want to sell it, yes, the price of the craftsmanship or whatever did eat a little bit into your profits, but you're still making a profit overall. So that's not too bad. Also, in terms of Sharia compliance, Some ETFs don't comply because some of them apparently don't own the gold. So there's a Shariah issue there because they're like selling or offering something that they don't have possession of. So you'd want to check that out. You could run it through Tabadalat. I'll put their link in the description. They are planning to launch a Sharia compliance screener in which you could put like a ticker symbol or whatever, and it'll scan it and do everything for free. So I'll attach that below. It hasn't launched yet, but you can sign up for early access. And futures, of course, are not allowed, but buying physical gold outright, you're buying it, wearing it, keeping it, whatever, that's allowed. So when would you choose each of these? So physical gold is if you just want to just keep it forever until you need to sell it, or never sell it and pass it down to your kids and just keep it in the house in case the world ends or something like that. And ETFs is good if you want it to be more liquid. You don't want to go through the hassle of storing it, especially if it's a big amount. Like, it's easy to store like a couple $1,000s worth of gold, you know, just like small pieces or whatever. But if you want to spend like millions or something, hundreds of thousands, then you'll have more sizable chunks and pieces and weight and everything, and you'll need somewhere safe to keep it. And if you have like a house cleaner or something, there's a risk they could steal it or whatever. So you don't want to go through that headache. You could just go with the ETFs, or even physical with a bank deposit, whatever, but then you have to deal with the insurance and the storage. And if you don't want to hold it for too long, if you just want to make some money on the price difference because you think it's going to go up in the next couple months or something, so easier for liquidity and stuff like that. And then futures is for like the active day traders who are like leveraged, high risk. Don't recommend. If you buy physical gold, make sure you buy it from reputable dealers, potentially from like government sort of entities like the Royal Mint or something like very as official as possible. There are some countries that have cheaper than usual gold, but even if you want to go to those countries, like I hear Indonesia has quite cheap gold, but you'd want to make sure you buy it from the most reputable place you can find, because you could get scammed, you could get less pure gold or something, which will make a huge difference in the actual value when you try to sell it. For ETFs, obviously try to go for as big companies as possible. The bigger the better, the safer, the more well known. Usually 5 to 15% allocation of your portfolio, of your whole like assets and everything, 5 to 15% being gold is usually acceptable. Even 15% I feel like is quite a lot. Maybe 5-10% is like the sweet spot maybe. So personally I like physical gold, and some gold ETFs could be the easier version of that. I don't have like a huge amount of gold that I need to pay for storage and insurance and things like that for. So for me the physical is working fine. But if I wanted to hold a much larger amount of gold, then maybe I would just go into ETFs, because I don't think I would want to bother with all the safety deposit box and all this, because in that case I won't be like seeing it or touching it or using it anyway. So an ETF is the same as basically having it in a safety deposit box. So that's my personal opinion. You can do your own due diligence and make whatever decision you like. So which one would you choose, physical or paper, and which exact kind of investment would you choose? Let me know in the comments. And that's all for this video. Make sure you like and subscribe and click the links below to find my socials and any other links I've talked about. And I'll see you in the next video.